Good morning. It's Marcus Burns here from Spheria. Thank you for joining us this morning. The quick agenda for this morning is that we'll take you through a quick update on Spheria as a business. I'll run you through our investment process and how we think about investing in smalls and micros and why we think they're a bit different from large caps. We'll also discuss some recent performance, divergence between smalls and micros and large, and maybe focus on that being an opportunity for us. And then lastly, I'll flag some examples of our process in action to show you how we look at cash flows and risk control when choosing some of the stocks we invest in for our fund. So on page 2, just a quick update in terms of where the business is in total. We're about 195 million of FUM. We've now been in business for just over a year. So the Australian Microcap Fund celebrates actually its anniversary yesterday. We're joking it's the 17th, the 5th, the 17th, and it was launched on the 16th of the 5th of the 16th. So we're very proud to have rolled the first year over on the Microcap Fund. As Mark flagged, we've been highly recommended for at Lonsec, and we have a recommendation from Zenith. And very importantly for investors, we have a limited capacity to invest. So we've promised investors that we will shut the funds around the $250 million mark for micros and $700 million for smalls. But Matt and I and the team are very focused on generating alpha for our clients. And it's very dear to our heart. So that if we find alpha generation is, or if we find it hard to move money around, we'll close the funds early. So we think it's very important that we align ourselves up front with you guys and with your investors, and alpha generation remains at our forefront. So we get asked quite a lot about, on page 3, how our investment process is different, and how do we think about investing. So we say we focus on quality businesses with a risk overlay. What does quality mean? Everyone says they buy quality businesses. To us, it means businesses that generate high quality of earnings streams, which means basically earnings streams are durable. I'll come on to give you an example later on about a stock where we don't see durability or we see some cyclicality in the earnings stream, and how we look through that cyclicality and try to find a true underlying value of the business. It means high return on capital and usually good free cash flow generation. They're the 3 things that Matt and I and the team look for when we're looking for high quality businesses. Secondly, we talk about this a lot, but we've got a free cash flow focus. That's important for a number of reasons, particularly in smalls and micros. And we belabor the point a little bit, but it's really important to understand that when markets go through tough times, as they invariably do, especially in smalls and micros, it's companies that can generate their own cash flow without resort to bank debt or equity financing that will see themselves trade through tough times. In fact, can often profit from tough times because they can either buy their equity back at discounts, or in many cases buy out some of their peers, if they're under duress during tough market periods. So free cash flow focus is core for us. Low balance sheet gearing, and then attractive valuations are the 3 things that form the bedrock of how we think. Thirdly, we keep an open mind. So this is one of the hardest things about investing, is that when you look at a business, either the share price or the facts or the management or some combination of those 3 things can change, and you have to be able to go back and revisit that stock or that idea. And there's a few good examples in our history where we've bought businesses that we haven't owned for a long period of time, and then there's been a dramatic change in the form of new management teams coming in that have catalyzed us to relook at the business and actually make quite good returns for investors. So, and equally, if things get very expensive or there's an exit of a good management team, we have to keep an open mind and ultimately exit that position as well. So keeping a fresh set of eyes is really crucial to this business, and we think our team can go through that and try to take emotion out and look at the facts. And then lastly, we do think that markets are relatively inefficient for periods of time in the small and microcap area. A number of reasons for that, but there's a relative lack of sell-side research. I mean, we're talking about over 2,000 stocks in microcaps. In many cases, there's none or one analyst covering those names. There's a long tail of stocks, and there's many different subsectors. So there's not the same narrow focus on large end. There's a very, very large myriad of different subsectors and themes playing out in the small cap and microcap area. So we think that gives us a good opportunity.
Okay, thank you, Mark and Marcus. It's Matt Bookie here. Just on slide 4, I think this slide captures a lot of what's transpired in the last 12 months. There has been a lot of money pulled out of the small cap space and also out of the micro cap space. So the industry funds have been pretty effective in pulling large sums of money out, and I think the future fund has also pulled money out of our space. So you've seen some big moves down in our space, and that has lended itself to presenting opportunities. What you've seen is an influx of money into the large cap space, and you can see the outperformance in that large cap company space, particularly the banks, I think, where the banks have rallied significantly over the past 6 to 12 months. The small company part of the index is relatively flat. But as you can see, the microcap space has actually diverged, and you've seen a big divergence in the last 3 to 4 months. The microcap index, which we constitute as the emerging companies index, is down around 10% in the last 3 months, ending April 30. Our funds are pretty flat over that period, so we performed well versus the microcap index. However, the small companies index has actually bounced pretty hard recently. You've seen a few of the bigger names in that small company space re-rate pretty aggressively, and we're not in some of those names. So A2 Milk is something we owned in the past where we thought there was as good value as a good company that was well priced. We now believe it's very expensive for what it is, and that company's gone on to do bigger and better things, and we think it's overvalued at the moment. So just moving on to the next slide, slide 5, and this just goes through the washout in the Small Ordinaries Index, and you can see there's been some big moves down in the past 11, 12 months. In some cases, stocks are down nearly 80%. Of that bottom 25, the other end is down 30%. So some big moves down, and I think in that washout there's opportunity. So we've been working through this space and looking for ideas. So we've gone through the likes of CSG, Reject Shop, Bellamy's, RCG. We've met the companies. We're working through the numbers, and we're looking for ideas in this space. A lot of these stocks we haven't owned in the past, but we've had a watching brief on. In the next slide, Marcus will talk about Isentia. It's a company that is in the bottom end of performance, and we've actually taken a pretty large position in Isentia. So I'll pass it on to Marcus to talk about that company.
Actually, the next slide is
That's a few forward.
That's a handball. Thanks, mate. The next slide is actually page 6, which is Vita Group. Sorry, guys. We put this chart in because it shows two important things about our process and thinking. You'll see 2 charts on the left-hand side there, one showing free cash flow conversion and then the bottom one showing margins. Automatically in our models, we generate at least 5 charts. These are 2 of those 5 that produce in graphic detail some of the key things we're looking at when we're looking at businesses. So free cash flow conversion, we've belabored that point enough times, but you can see the cash flow conversion of Vita Group has been very good historically. So the average is 138% of its reported EBITA gets converted to basically cash flow. This is post-capex and post-working capital changes, which is a really good conversion rate, by the way, and thus attractive on the face of it. And we've owned this stock in the past, but I guess what made us cautious was if you look at the margins on the bottom left of that page, you'll see that Vita Group floated back in 2006. Vita Group is a phone retailer called Phone Zone and runs a T-Life stores in Queensland on behalf of Telstra. So they're basically a retailer. They get paid a commission by Telstra to resell phones. But you can see the margins were very high when it launched in 2006 or was IPO'd. And then due to a variety of renegotiations between Telstra and the company, those margins were squeezed and got down as low as almost 1.7, so they call 2%. It then had a massive recovery in 13, 14, 15, 16 when margins completely recovered back up to almost 8%. I guess one thing that Matt and I look at is how durable or sustainable are those earnings. And if you look on the right-hand side of that chart, you'll see 2 other tables that we generate for every business we model. The first is a risk scorecard where we look at things like interest cover and cash and forecast interest cash coverage. But equally importantly, you'll see on the bottom of that is a pretty standard 4 to 5 forces analysis where you look through all the different trends and forces that basically impact the earnings stream of that company. And you'll see there that, for example, the bargaining power of suppliers, it scores very, very lowly because Telstra is a monopoly supplier effectively of the phones these guys sell. So that's an annual contract that Telstra renegotiate with Vita Group, and when they were earning 8% margins, we thought that was basically over-earning on a long-term basis, and we had previously exited our position under a former shop. The stock kept running because I think people were capitalising that number, but we were very cautious given we thought that Telstra might go back at some stage and renegotiate. And indeed, what came in the press in September last year, and then again in November, and then back again in January, February this year, is that Telstra and Vita Group were in the process of negotiating, and there'll be some squeeze on those margins. So that stock is now come under massive pressure, and is now actually bizarrely reapproaching levels that we think are potentially attractive. So that shows you how we look at earnings, the cyclicality of those, industry analysis sometimes, and also keep an open mind so that if the stock does get beaten up enough, we might seek to rebuy that for the funds.
Yeah, we think there's an interesting play here because at the end of the day, we don't think Telstra wants to sell phones. We think Vita Group does a really good job selling phones. And, there's just a bargaining situation, and it's a bit of brinksmanship, and we think at the end of the day, there will be an outcome. Obviously, it will probably skew in the favour of Telstra, but we think Vita Group will survive and will generate money. We just don't think it's going to generate the current margins that it's currently generating. So, if you put 2 to 3% margins into your model on a similar revenue base, you get a valuation in the low ones, and that's currently where the stock's trading. But there's a lot of water to flow under the bridge, and we just risk going too early at this point. Just on slide 7, Infomedia is a company that we've acquired early in the piece. We've known it for some time. What changed our minds on this company, and clearly its cash flow fits the bill, what changed our minds is a new board came in and a new management team came in. This was early last year. And instead of milking the business and cutting costs, they came into the business and actually looked to grow the business. So they've invested in the business, they've invested in sales, they've invested in winning market share. They haven't won market share for a long time. And you've seen the early wins on that. They won a big contract from Nissan in Europe, an EPC contract. And they've also got the ability to win market share in the US as well. So Infomedia is a global player in the EPC catalogue market. We think it can continue to take market share. We think it's primed for growth. It's got a great balance sheet, net cash. It generates good cash flow. Its returns are good. It's got a product set which we think is leading edge. And now we think it's got a management team which can get them to where they want to go. So we're very bullish on Infomedia. We don't think it's expensive, and we think the opportunity set is quite large.
Yeah.
Maybe on slide 8, Isentia. Sorry.
Just on slide 8, this is the stock that I was supposed to say before, but so Isentia is a media monitoring business. So it tracks the mentions of brand names or keywords in the media, not just in print, but in print and radio and TV and online, etc., etc. So it's pretty key for brand owners or people who are interested in tracking various hot topics in the media. So Isentia listed 2.5 years ago, 3 years ago, to a lot of fanfare. We looked at the business at the time. We liked the business. At the time, Matt and I weren't given sufficient time to do the research on the business because it was one of those aggressively marketed and thus listed companies from one of the brokers. So we declined to buy the stock in the IPO. It performed pretty strongly, but then basically back end of last year, it had a couple of hiccups where it bought a business called King Content that it may have overpaid for. So it bought that, and effectively it started losing money quickly after being sold to the company. So that doesn't look good, and stock got marked down on the back of the capital allocation. And then a leading competitor called Meltwater, which has actually been in the marketplace for some time in Australia, started being very aggressive on pricing and started winning some market share from Isentia, who had been raising prices pretty aggressively in the background. So that saw Isentia lose a little bit of market share, and the market extrapolated both the poor acquisition and the market share losses and really marked the shares down aggressively. And what we saw, I guess, was fundamentally a very good business. You can see the cash flow conversion there at 77% was pretty solid. It's got a 65% share of the Australian media monitoring marketplace and is pushing into Asia where it's getting good growth. And we saw a management team that was responding to that by creating a new product to compete with Meltwater. It stopped raising prices so aggressively and was actually holding, if not regaining, market share. And a couple of banner clients, so things like the Prime Minister's office that had left Isentia and gone across to Meltwater, actually came back to Isentia because they found the products that Meltwater were actually inferior to Isentia, and thus was worth paying the premium to Isentia. So on the table on the right there, to give you some examples of the depth of the product that Isentia have. They cover regional media, they cover radio stations, as well as all the online content that Meltwater and other competitors cover. So the depth of that and the fact they've got client management skills which vastly exceed the competitors have meant we think the business is much more resilient, and we bought those shares in the last few months, and it's become quite a big position because we think it's extremely cheap given the quality of the business and the short-term perceived nature of the competitive activity, which we think is overblown.
Just moving forward to slide 9, we'll talk about a couple of companies that we don't own and the reasons why we don't own them. We're not saying they're bad companies, we're just saying that they just don't meet our process requirements. So Catapult Group is a company with a market cap of $340 million. It hasn't generated a profit yet. It is a recent IPO. It listed a couple of years ago. It seems to have a good product and a big universe to grow into. However, our concern is the cash flow. In the March quarter, it burnt through $7 million of cash. So that's a real $7 million of cash that's gone out the door. it only had $6 million of cash left at the end of the quarter. So basically, if that run rate continued, it would have been out of cash within the next quarter. Clearly, they had to come to the market, and they raised $14 million in early May. Obviously, that gives them some buffer. But we think there's a lot priced into this stock. It really needs to move into positive cash flow to justify its valuation, and if it doesn't, you've got a problem on your hands. So we try and curtail risk by avoiding buying companies that are bleeding cash. They might be a good concept, but they don't really fit our process. So we'll keep an eye on Catapult. One day it might be interesting to us, but at the moment, the way it's burning money, it's just not of interest. Moving on to slide 10. This is just a bit of second order thinking and a bit of second order work that we do. So API owns Priceline Pharmacy. You've probably heard of it. At face value, it seems to generate strong free cash flow. So you can see the dark blue bars historically versus the light blue bars. So the cash flow conversion's been pretty strong for the group. However, we note there's a little quirk in the accounts. These guys use an off-balance sheet securitization program. So they bring forward cash flow through the operating line. And if you adjust for that balance sheet debt, there's circa $300 million of debt off balance sheet. On top of the leases, they've got a big store network. This company is a very leveraged business and therefore very risky in our view. More recently, Soul Patts, which is a cornerstone shareholder, sold its stake down from 25% to around 19.9%. So they've taken money off the table. The stock's had a halcyon run. Solomon Lew, who'd bought a stake at, I think, 20 cents a few years ago, sold his stake out, I think it was around $1.80 last year. So there's been a few insiders, a few smart people exiting the register, and that does concern us. Also, Stephen Roach, who was the long-term CEO, left the company a couple of months ago as well. So we just think it's one to watch out for. There's a few funnies in the accounts, and that could lead to some issues down the track. Let's move on to slide 11.
Yeah, so just to conclude, I think we try and demonstrate we've got a very robust process in micros and smalls that that's focused on risk. So one of the things we haven't touched on is that historically our beta and effectively our beta and our risk, all the risk scores around the funds are actually materially lower than the benchmark and many of our peers. And that's something Matt and I are quite proud of. And one of the things we focus on, and we think it's more of a fact that we do focus on free cash flow and balance sheets and valuations, and they're really critical to how we build portfolios. We think that has generated a lower risk than many of our peer groups, and we think that's key to how we think. And then finally, we think that the managing in the space and being aware of capacity limitations is actually crucial. And the promise we've made our investors is that we will close the funds when we get to levels that we think are manageable, and we won't go beyond that because there's no large institution forcing us to do that. We are managing for investors. We run for investors. All of us have exposure to the funds, and our families do. And so we will make sure that alpha is paramount to how we think and invest.